Hello from the children of planet Earth. Hello from the children of planet Earth. Hello from the children of planet
What's up, party people?
Hello from the children of planet Earth.
What's up? What's up? What's up? Good morning. Should the building permits come out this morning for November? Just come a slight miss. Housing starts 10:30. We got Atlanta Fed, GDP now coming out. Could be a slight little event off of that. What's up, friends? There's friends. Oh, there's no DB features. Hold on. All right. Oh, DD band is. Oh, well, let's get it drawn on the screen then. This is H24 contract 21 and 59. Hold on. Last Christmas. EPH24 4821 4759. 4821. And let's just get this thing really quick. 4759. All right, markets are open. $379, okay. All right, let's see. We have another golden setup today. All things green. Remember that video yesterday on golden setup resilience looking good. Opening here at the open. Let's go ahead and have some fun with this. I don't see anything alarming right now. Why don't we get it right off that open? Was DD touched? Hold on. Where? $47.59. And it doesn't look like it, was it? Only gets 1 second. I'm not gonna think it's one. So Sir Leon said that housing starts came out 156 on a 136. Okay. Let me log in really quick to my Thinkorswim. Hold on. But long up, golden setup, everything looks good again. I like it. Hold on, guys. Okay, give me 1 second. Wait. Okay. Sorry about that. You said DD band was touched. Where? By who? Don't say stuff like that if it's not true. Itai. You sure? Bro, don't make mistakes like that on the stream to everybody. Please. Don't mind. You just gotta be careful there. Okay, we're totally fine. Okay, we're looking into it real quick. Sorry, 4821. Okay, so I'm looking for another golden setup opportunity here. This is just like yesterday's setup. Good morning, friends. Remember, we got some events and news and things today. So, don't sleep on. All right, look. Here. DD, same thing. D. So we'll check VIX. Hedge pressure right underneath here. Looking good. Keep an eye on Res. Res is good. All lights are good. QQ hedge break to the upside. That's even better. A holiday sale? No. We don't do a lot of sales. We had a Black Friday one, but I haven't planned on doing a holiday sale. I think you could still get the 20% off a lifetime though. That's probably, I'll be honest, in my frenzy of trying to get the marketplace on, I don't think I've canceled the coupon. So if you want the 20% off a lifetime from Black Friday, you guys, it's still there. I bet. Send me a message in Discord and I'll hook you up. Yeah, it's still on the stream. This is how much I need to sleep. All right. So we're trading inside the DD bands here. Things are looking great. VIX. Now be careful today, guys. Now here's one thing. Upside could be limited because VIX has a bounce point right here at this bull zone. So be careful. The one caution we do have, I'm gonna circle in red on the stream. Here you go. Check it. Check it. Check it. Right here. Caution. Upside move will bring VIX down, and anytime VIX bounces, we get that light turn on the zone bottoms. So be very careful here. Resilience also pulling back, so we can make sure this thing is holding the fort. Let me double check Qs really quick. Pull long up on Qs, same way. UVXY looking good. So liquidity maps are good. Going to show me it's the same thing. Open blue, open. If we support here, go up to next resistance DD. We're trading at all-time highs. 4,800 and some change. There is no gap to be filled up here, I don't think, on the SPY anywhere soon. Is this all-time highs yet, or just yearly high? Well, this is all-time highs, aren't we? No, it's not. I'm lying. 479. We're close. Let me see if there's any gaps that need to be filled up in that vicinity. And there aren't. Okay, so there are no gaps. There's like a couple psychological levels about. Let's see how many points higher. Not at all-time highs. Yeah, just yearly highs. Okay, about the 480 level, and we're trading right about 473. So there's still 70 whole points to go to get highs. Obviously got a little bit of room. Yeah, no black, right? All right, thank you, Sir Leon. Hit me up with those housing start numbers. Let's go. Let's read them up. All right. So today we had U.S. building permits. Just seeing, this is the change in the number of new building permits issued by the government. So change in new. So the change, if the change is going up, it's accelerating. So that would be the derivative here. So if the change, like essentially, if the thing is sloping down, then the change is slowing down. Like there's fewer and fewer and fewer going up. So like a sloped line is either going to curve down or curve up. And I guess since December 2022, it's slightly curving up, which is good deal. Not accelerating super fast, but just a little bit. Housing starts, change in the annualized number of new residential buildings again during the reported month. And apparently this is a big spree. 1.5 is pretty huge. The biggest number that has been since early 22. Interesting to see some growth there. And again, all bets right now are on that big soft landing the Fecky's talking about. What is a soft landing, you say? Well, it's that they were hoping to buy enough time with their rate hikes to help the inflation numbers while simultaneously letting the job market improve and heal the economy on its own. And all the little data points are going to slightly turn around slowly. There's a little soft landing there. And it looks like we're getting that. Not a lot of stuff is really bad. GDP is looking great. Jobs numbers looking better. 10:30, we got the GDP now. So if you just be aware of that, that's going to be coming out. A little catalyst action this morning, hopefully, maybe. Just seeing what they think going on here. Atlanta. All right, you guys, let's take a look at what we got. So watch that DD pulling back and play with. I like this. It could be another golden setup because, like, remember, I want to long out of there. Gotta be careful on this. There we go. Just be careful here. The VIX is going to get... This is going to be not the easiest day to trade. But we'll take it anyways. Do I look at SPX? Nah, because SPX is just an index. Like, it is good. We look at SPY instead because SPY has its own supply and demand independent of the index, right? So SPY tracks the SPX, but SPY also trades on its own. You get kind of two burps of information there. So like tools like resilience, great question. So what we do, Wealth, is we look at SPY to proxy the SPX. SPX will pivot when SPY pivots. Its options are also a good liquidity map, but the reason that we don't is because SPY is hedged. SPY options are hedged with SPY shares. It circles back on itself. SPX options are hedged with, there's no such thing as SPX shares. So they're hedged with cash, they're hedged with stock, all other things. So you can see the volume spike in SPX. Think about it being contained within itself. So it's a stronger indicator of volume prediction. It's a great question though. Right. So if you hit hedge pressure, SPY's going to get a flurry of volume. And so since we're trying to trade with volume, even though it'd be nice to have like an SPX liquidity map, we didn't go out and buy the data feed for it just because you have a liquid options chain SPY that's hedged on itself. So it's a better read. Yeah, or futures, like as Serliana said, like it's the fact that SPX hedging goes all other places makes it hard to we want to read the best of all the asset classes, right? Does that morning bell always happen? Oh, Thinkorswim. That's just because Thinkorswim's always open, and today it wasn't open. Good, good. Like, market's still trying to sell a little bit, but I kind of like what I see. Let's golden setup. Let's hit it good. Let's hit it pretty hard. Why not? 15. All things pointing up. A little bit of index divergence here. Just be careful on the resilience number. Remember, resilience can forecast a hedge pressure break. So while I don't bet that happens, hedge pressure break is the least probable thing. Remember, we talked about between 10 and 25% chance is kind of what the backtests have shown that hedge pressure breaks. So most of the time, open in bull zone, close in bull zone, open above hedge, close above hedge. Pretty common. Let's wait this one out. Let's see what we got here. I think it's very possible, yeah. Quick little move there. And while we do have, remember, I always close out when we get those VIX little bumps here for whatever reason. Let's go ahead and, I know I feel this is going to sound really weird, but I kind of want to trim some of this for whatever reason. My brain is like, take it easy today. Take it easy today. Let's let me take the scalp real quick. I don't know. I'm having an icky feeling because of the VIX thing. So let me go ahead and just take that 300 bucks and call it. Give me a second. I'm going to wait and get that hedge bounce on the news. Whatever. Monthly map's looking better. Okay. Let me get my posture real quick. bull zone bounce. So like VIX is getting close to a pivot, and there's a news event coming out. So like, well, I kind of don't want to be too heavily invested because resilience is starting to pull back and it's kind of right on the edge and it's fighting a little bit. Well, I should stay committed to the trade. I did make 300, which is good. So what I'm gonna do is just close it out. We got GDP now coming out. Got some possible things. I'm gonna let this test out. I still think it's going up, but I kind of want to trade it a second time. Let me take a look. That candle just popped up very rapidly, so that had me a little worried. There's 4 or 5. I saw a huge flurry of volume right here. Could be a shakeout candle. I'm not really sure, but what I'm going to do is wait on that. Let this develop a little further. See if I get a hedge bounce and take it, because this is going to create this will create volatility. So if you know what volatility is that volatility is the amount of ups and downs you get. So if we get this and that, then we're going to get some V's to play off of. Right, the V's get bigger. So instead of betting like yesterday that we were going to go straight up on a golden, volatility is going to be prominent. So it's going to look a little different. It's probably going to have some V's, because that is doing that. I think I'm going to get a second trade in here. I'm going to use volatility in my advantage. This is where the professional info comes in. This is why you guys are here every morning. You've been doing this for a while. You know the difference in two trading days. There was no VIX problem yesterday, right? So the market just kind of inched right up. Volatility is going to give you some dips to play with. Maybe some big V's, some small V's, and go up. So I believe that I'm going to get a new entry point. And oh, yeah. And Russell just hit ED. Sorry. Yeah. Did I not say that? My bad. Yeah. Sorry, did I not say that? So even though it's, you know, different than the S&P, it's different stocks. It still kind of represents one of the, you know, indices in DD bands. We also have a 4817 yellow line coming up. So inside of here. So yeah, of course we hit that on Russell. So we'll wait on that. I'm gonna just wait for a bounce and play a lower dip. I'm gonna take this one pretty easy. I think we're still going up. No selling off, no shorting, nothing. All right, so we got the GDP now stuff coming through. I mean, actually, honestly, the economic data is looking pretty solid these days. I'm liking what I see. We're checking on the DD band thing. They put out a new release last night. For some reason, it broke DD bands. So we're going to double check on what's going on there. We're doing some optimization runs on things having to do with the drawings and display features. Monthly maps drawing, not having to click refresh, everything looking solid. So like, as you see, the improvements are pretty much there. Wow. Okay. So we had this before at the beginning of the month. Last month as well. This little kind of showing some possible vol. I don't know if he's out of the money calls, probably massive amounts. So we'll see what this is all about. But in general, there is still pockets down in here. Bullishness to just kind of have this like possible volatility. So somebody's prepping for something, or that's probably some kind of calendar credit spread. We'll see. Still looking solid on the monthly maps. Oh, let's go. These are looking great still too. Okay, so that's bullish on the same side. Pretty much golden setup again, everybody, today. A little bit of divergence issue, a little bit of possible VIX, so kind of keep your eyes on that. Please, somebody said. The new triple B calculation comes out tonight when futures market opens. So what? Please check the dynamic does not work on Z contract. I'm sure what you mean, bud. Can you rephrase that? What do you mean dynamic does not work? On the, you mean on the bot? The bot is referencing the H24 contract. Let me double check that. It could be a mistake. Y'all need if that happens, y'all need to message me in chat. Like once I do those, I usually run the bot and then I run off and do like whatever, so I don't see a lot. What you guys see. So if it does that, just let me know. Just send me a DM. Man, the Christmas music is giving me some good time feels here. All right, so looks like we're still trying to push up here. Just because we have some possible bull zone tap of volatility, I'm just gonna holding off on this one to let it pull back, and then like I think that you might get some better dips and moves on this. Plus, you hit the Russell DD band too. I mean, well, I do think we still go up. I would like to get another scalp on it. So with Russell, IWM hitting the top here. I'm just gonna like see if that pulls back and gives us some wiggle room to play on another dip. The S&P is moving faster than NASDAQ as well, so we have a relaxation, a little bit of sector cycling out of TAC and into greater bull market is still there. We'll talk about that in just a second. You remember, so we always look for those. Really quick. What is DD BAM? Oh, okay. So let me show you something, Steve. So if you ever, do you use the Rocket Scooter platform? Who here has never used our platform before, by the way? I'll walk you through some of these things. So ignore all the junk on the chart here. There's so much lines. Okay. So what we do here is we have a very extensive training program. We use our own platform and our own indicators that we've created, which I will show you here really quick. So a very sophisticated and simple to learn trading style. It has, here's a summary of all these inventive tools that we have created. They're volume prediction tools. We have entries, exits, and risk management trade plan. And you can learn all of these things in our Discord. If you join the trial, you can do that really quick. Kind of like just burn through it. We have like 3 major tools that we use for entries. We have like 5 major things we use for exits. So anytime, like one of the exit tool targets is this band. This is probably one of the most, I'm gonna say this. Everybody, risk interval DD band. If y'all want to comment in chat for the new folks that have never been here, this number is magical. Like this thing is just, watch this. Look, you see this? This is the S&P yesterday. If you traded long yesterday and exited a DD band, say I longed yesterday, got out DD. This is a futures hack. It's literally kind of what it is. We're exploiting something very key that the CME group created for setting minimums on performance bonds and futures. So this is a hedging area that you touch these bands. There's always going to be some kind of resistance. Doesn't mean it's going to reverse, but there's resistance. It's a volume predictor, just like everything else. Do you see how futures right here, everybody? So Rocket's here, we've created a series of tools that can actually predict where high volume will be, where it happens. These bands show up the night before, and they sit here all day. So any long target, we usually exit at the band and then relax. Like outside the band is something we don't trade. Markets become irrational at that point. So one of the exit targets in our style is the band, because as you see, there's high volume. So I'm going to trade where markets are looking for sellers, and I know the volume is going to produce some sellers. Doesn't mean it'll reject, but this is my exit target, right? A lot of people, super easy day yesterday. So a lot of us traded, I think, like here to there. And that's a pretty common like place to exit a trade. What it's exploiting something very key. Let me see if I can open up more days. Look at 3 days ago. So there's something really interesting going on at this fixed distance from the close of the previous day. Exit target here as well. See how sometimes it can break and keep going, but sometimes it hits and pivots. In day trading, I always exit at the band. It's just my first exit target. Now, when it comes to index trading, whenever one of the 3 indices, Russell, Nasdaq, or the S&P hits its band as well, then the other 3 we consider the other 3 likely to pivot. So because Russell hit its band and I exited my S&P trade, I usually exit when one of the 3 hits the bands. Even though I'm not trading the Russell, look at the Nasdaq, you see how it's turning down. Look at the S&P, see how it's turning down. Do you guys see that? This is where decade of experience comes in. This is, again, another solid gold chunk of wisdom. Because this has hit its band and it's likely to have some pivoting action, high volume. These are likely to create volatility. As I mentioned earlier, we're going to experience some volatility to play off of because of the VIX thing. So all these things I'm teaching you guys here in the stream are things that you can learn in our videos. So, like I said, if y'all are interested, hit our Discord up and send me a message. You can go through the training program and use the platform itself. Killing it, Dylan. That's right, baby. All right, so now you understand that by proxy, this is an advanced topic, that when one index is pivoting, a lot of times the other ones will follow. That's a thing to keep in mind. Yeah, you have alerts. They're right here. Jesus. So that light went red. When one of the index lights go red, I usually consider all of them red in my trading style. And I'm like, okay, I'm gonna get out of some longs on Russell because SPY hit its area. And see what I did on that quick little candle up on SPY that we had earlier. I exited right here and I would still be upside down and I didn't chase. This is the difference between me and most of you, and me and every single newbie out there on TikTok trying to trade. We understand that volatility is present. I even drew on the screen that we get some V's. There it is, right? So I said it's likely not going to be a straight up move like yesterday. And that comes with another one of our rules, this bull zone bottom and VIX thing. So each one of these are part of a rule set that we teach. We have so many different things that we teach you. None of it's technical analysis, not the traditional thing. It's volume prediction and understanding volatility. We have 15 different tools we've invented here. And they're unlike any other kind of tool out there because they're not technical tools. They're exploiting things. So this is an exploit, these bands, of a protocol that is used by the CME group to set to limit what clearing firms can minimizes the margin requirement for trading futures. There's a whole risk equation that goes into what that margin requirement is for every futures contract out there. We reverse engineered their protocol and we give you these numbers that are these bands that are just razor sharp pivots in anything that you trade. Anything. They're going to be pivots, whether they reject or they fight and break. One can argue that when you hit them, see how it's random after that, goes up then comes down. Russell the other day hit it, came down, hit it, broke through. It's a coin flip at that point, as you can see. So even if it broke out and I chased along, look, it killed me at the end of the day. So what we usually do is the predictable part of the day is inside of those bands. And when you break those risk limits, it's just no dice, right? So you're going to be gambling at that point. So we teach you like where you want to exist in the market, where it's more probable, and where you don't want to exist in the market, where it's just a gamble. Let me show you like NASDAQ, right? NASDAQ gets a little spastic. And this is why the band is usually the upper limit on any trading day. As you get close to it, it's the end of the day. You get close to it, it rejects. You hit it, it flies around and then becomes more volatile. You hit it, breaks up, comes down, rejects. See how it's random once you go through it. So anytime you touch the band, that's the predictable part. Close out. Anytime you touch the band to the downside, predictable part. Close out. Look, it chops around and comes back in. You get to here, close out. This is just your day trading portion. It hits here, close out. Hits here, gets close, whatever, close out. Hits here, closes out. So you see the random action when you hit the band. This one goes up and comes back in. This one goes down and comes back in and then comes back down. This one hits it and goes. This one hits it and quits it. Giggity. This one gets close, turns around. This one hits it, fakes you out, and then dies. I don't think any one of these 6 look at all like each other. They're all different. But you know what's interesting? Each one of these, once it gets to it, it looks like it just walks right to it. Walks right to it, walks right to it, walks right to it. So those all look exactly identical. So why trade this bullshit and not trade this good shit? Right? Is this indicator indicated in the membership? It absolutely is. Now I just draw on Thinkorswim so I can draw the history of it there. We just incorporate it into our platform. If you get our platform, we have a futures data feed. The indicators are here. If you don't have a futures data feed, we give you the numbers here and you can draw them yourself. Any futures contract will have them. So what it is, it's the first line of defense on an exit target. I've drawn mine here manually just to demonstrate how to do it. Any upward move from here, once it hits there, we just say the market is random from there, as I demonstrated earlier. You can do one of a million things, and it's just unpredictable. So what people here like to do is they usually just be like, okay, well, I'll take my $1,000 and call it a day or whatever. Or they'll say, I had 10 contracts, let me close out 8 and like hold 2 as a runner. Right? Take the majority of profits as we teach at those bands on either side. And then, you know, play the volatile shit show with a tiny more position. If you feel like playing roulette with the stock market, then that's up to you. So the membership here is you get access to our platform. You get access to the data feeds. You're going to get an optional futures data feed to automate drawing some of this and have these alerts for you. And then all the tools and everything come with the platform. And then we have like training and education that you can learn how to use this stuff as well. I'm watching SPY, not futures on the platform. Well, that's the thing. So you need to put up a futures chart to see the future stuff. You only see these alerts if you buy a futures data feed. That's the only way for us to do that, because you have to have the futures cross over that to be alerted that that happened. So you need the futures data feed. Is there a study for Thinkorswim you can share for this? Yeah, you got to go. No, you have to go by our platform. And those numbers update on a daily basis where those bands are. So every night we have this updates automatically. Where can you find trader reviews? I'm not sure. You mean for us? Everybody here, somebody asked for a trader review. Write something in chat, like 1 or 2 sentences. Talk some shit or say something. Be honest. Give me a quick review. There's no review. There's no reviews that I think there are. We've been around since 2016. There's not a single bad review out there. For sure. Who uses the soft? I mean, everybody here that's watching the stream uses the software, but tell this person what your thought is. Just be honest. Don't fucking brown nose me. Be perfectly honest and just say whatever you think. Yeah, Shark Busy's been busy. Actually, literally been busy. Thank you guys. We're not like the here's the thing, like we have the best tools on the fucking planet. I'm not gonna lie. But we're not the group that goes out there and parades all of our traders winning trades. There are people out there when they're one trader. Like here, I'm reading this really quick. Like this, Jared passed his first prop eval yesterday using Rocket Scooter. Nice and consistent if you use risk management. Like he posted that in chat. You don't see me out there on Twitter like, check out my awesome student. Look how great they are. Buy my stuff. We're like we have the integrity to us is that we're very honest about, you know, like presenting our tools at face value. While I do have a ton of success stories, looks like they're fucking piling in here. You never see me or Ashton go out there and try to rub it in people's faces for sales. We're both very honest men, and we think that that's kind of low ball and shady to do so. But if you ask for reviews, we'll give them for you. There you go. Dylan got 3 wives. Dude, you're right. You know how reminding me of the fucking, what's it called? Remember the 3 Wolves t-shirt that was on Amazon? That was like that whole thing. No, I know it's a meme from a while ago, but that's classic internet meme. Like I bought this t-shirt, then all of a sudden I grew hair on my chest. I was howling at the moon and ladies couldn't have enough of me. But anyways, so like, I'm sure we could go out there and tell people to go write good reviews and do all this stuff. We actually never did that. Here's what people are telling you. These are all users of the platform. Good job, by the way, on your eval. Bar McCallum, work here is amazing. Made you go from me sending your comment 20 times to passing 3 of them. That's definitely because of Dookie, the magic cat that comes in here and helps you guys. Solid platform to get market overview direction. See, Jesus gives a little pretty honest, just solid, gets you some directions, helps you see things a little better. You guys are awesome. Yeah, y'all are being hyper flattering. Oops. Yeah, I'm gonna. Just so I can share these with the team. I'm gonna actually share these with my executive team. They'll be happy to hear this as well. All you guys' commentary. This lo-fi Christmas music is fucking banger. I love it. All right, where is my project channel here? We got on this. Thank you for tossing a review, you guys. Y'all are pretty awesome. A lot of new folks in here for the first time. What else to read some of these other ones? All right. You guys said Kyle's been around forever. Kyle's calls it OG. My brother from another mother. Been here for a bit. So, better than any Discord group BS, Rowan. That's true. Discords are kind of, trading Discords are kind of like, they're good for being social clubs for like-minded traders. And I say that tongue-in-cheek parody because literally you're going to be around like-minded traders. Probably a bunch of idiots, and you could be an idiot and hang out with them as well. Like a little jab to the discords of the world, but you will certainly be bound like-minded people for sure when you join a Discord. Watch it just. But where our Discord is mostly for educational purposes. It's not like a trade room Discord. So we can train you on how to trade and use the platform. Lots of education, lots of learning. If you want to setups and trades at work, Braxter is awesome. Robbie, my man, you want to gamble or want to shoot for the moon? Yeah, go somewhere else. Great system members, you guys are great. Thank you, Sam. The platform is great. User levels for buyers and sellers would show up from most stickers is amazing. So one of our major techniques is liquidity map that mashes together a couple of indicators, and it's basically like an overall flow kind of pressure of where flow is likely to take price. And you see, like, if you look right here, Sam, liquidity map has some letters, and then you have a little guideline of what those letters are. And as you see, there's a legend that's in this little document we give out in our cheat sheets that show you what all these little things mean. And these are all the different plays that can possibly be there. This is forced hand buying and selling just based on the hedging against the options sold in the market. And so you can kind of see how, like, the S&P, you see how it's dipping, and it's right on that blue and that pushes up, around that blue and pushes up. If you break the blue, it can fall to yellow. So now I have places to take bets in the market just based on where price is likely to go based on the net sum of least risk of all participating traders and dealers. And so while it's, looks pretty great as to what the arrows are showing, it doesn't predict the market. It's just showing you where pivots can be. And so I have to make a bet based on all the different tools I have to kind of weigh out where I want to trade. Like this morning, I opened up and made like a quick $300 and then I closed out. I still want to trade further, but we got some Fed stuff coming out and we're going to kind of wait on that, trade off of it. So just FYI. Tommy says, pretty impressed with the capability to predict where index will move. The volume doesn't lie. Indicators can't predict price. Dylan is saying, like, our motto here is you can't predict price action. Stock market, this shit's random. What you can predict is where volume will be very easily with our tools. Our tools will show you where traders will be. You just don't know who's going to win the fight when you get there. But any one of our little hedge pressures, half caps, all these different things, we've invented this whole process. Anytime you touch any of them, it's predictable, high volume, predictable, and it's almost never wrong because traders will be there because of the mechanics of hedging. They're the same across the board. So hedge pressure does that, absorb all the content. You'll be surprised you look sooner. Stop guessing and focus on where traders enter and exit. Yeah, we narrow down things to like a couple of areas of interest. Jace, I've had 3 straight max profit scorecards cards for a clear hedge pressure balance at RS predicted. So it'll likely be the 4th one. Jace over there killing it. Never use this early on, but keep your personal daily range data. The hedging bands around the indices do exist. Around 50-60% from the open, all at the normal daily range. So you have a daily range setup system. The hedging bands around the index do exist. Yeah, so he's so you're understanding a little bit early on, like why we're looking at this. Right, the margin requirements set by CME span, or that the minimums dictate a certain amount of risk in positions held in futures, and you have risk outside of these bands. And so, because people understand there's risk outside of those bands, they hedge in those areas. So we've calculated where that hedging exists, and it's very, very accurate because it's exploiting an actual equation that the exchange uses and regulates and requires all clearing firms to follow, which means every trade that you execute is against a market maker who is reporting their positions to that risk equation. All right, set aside at least 40 hours to learn, about 3 or 5 weeks to practice. Oh, that's cool that you said that, because I didn't know how long people usually spend on the program. It's about 3 to 5 weeks to practice, so it is not long to learn. We're down low and not flashy. We just wreck, as Kyle said. Dude, it looks like everybody here is pretty happy with the service. We have 5,500 people in our Discord, I think, something like that. Yeah, 5,510. You've got probably over 5,000 user accounts in our first year. Probably 1,000 something lifetime members. It's a lot. It's a pretty sizable thing. I don't know how many active monthly subscribers we have, but Probably 1,600, give or take, something like that. So there's a lot of people in our community. We grew pretty quick. And we're just a trading platform. It's a trading community of like-minded traders. Oh, y'all are flattering. I was thinking like 2 or 3 people were going to say something. Looks like y'all all jumped in. Works great. A bit of a learning curve. Worth putting in time. It is definitely a learning curve because it's new. It's a whole different concept. It almost has to unlearn all the stuff that you guys learned when you were younger. Like, which time frame do I pick? Which candle do I pick? Which indicators do I add? And so with our platform, you just open it and nothing. You don't change these. You don't add anything. You don't add a bunch of squiggly lines in your chart. It's all, for the most part, unlearning. That's kind of learning curve, what you traditionally thought. Momentum and all this other technical style, you have to kind of like unlearn that and start fresh. I think that's the hardest part. Resilience is fantastic. Also learned some serious patience, which previously did not have. Jace, honest review. About 80% of the time, Matt is correct right at the open. Yeah, Bonnie Tech is always honest. That guy's always honest. 10% of the trade will eventually turn out the way he planned, but there might be some adjustment required. 10% of the trade was wrong. Yeah. So like right out the door, I'm usually right at the open, which is usually correct. And then if I have to adjust, I adjust. And then about 10% of the time, the trade was wrong. So basically, like I have a really solid idea of the market. I know when to cut quick. And then it's not wrong that often. That's what he's saying. Oh, cool. Subscribe to the platform. Yeah, check it out. Just try it. There's like a monthly subscription. It covers your data feeds, your data costs. And honestly, I think like the best part of here is that you're going to learn a bunch of different tools that are something you've never learned before. Add them to your arsenal. Like high volume prediction is a very key part of what we do. And so I use Thinkorswim because I have a grid here. Rocket Scooter can't show 4 at once on futures. We're barely getting futures data out this year. So for now, I still can manually do it in Thinkorswim. You see how when Russell, I can tell you guys right here. You see how whenever you hit these bands, like, and you're playing with them, there's a lot of volume that's taking place exactly here. Hedging just exists right here. And a lot of times when I'm trading, once I hit the band, we say the day is over. We give you an alert that tells you that it's happened. So normally, like, the day trading part of the day is over. Look, Nasdaq is just chopping around. The S&P dipped and is trying to push higher. Doesn't mean that the market's going to reverse, but I just know that it's going to like hiccup. And also we have GDP now coming out today, right? So that's probably going to create some turbulence. I don't like to trade into a catalyst. You guys know the drill. Oh, awesome. All right. You pay for futures data on TradingView. Is there any way you can connect that versus buying another futures data from EdgeClear? So who do you buy your futures futures data from? Jesus. So we have a connection to CQG. As long as you have a CQG account, you just need to get your CQG account tied to Rocket Scooter and their CAS system. You would call EdgeClear and tell them what you're dealing with and see if they can help you out. You're not buying another data feed from EdgeClear. You buy the data from the FCM that you have. So if you buy it for TradingView, it doesn't really, you can't really transfer data feeds to other platforms. So what I would recommend you do, hey, does TradingView work with CQG? I think it does. Magic Cat on live stream just showed up. Boogie. Should I long or short the S&P? He just told me to long. He actually said full port YOLO. Tesla 10,000 call? What? All right, now he's just giving me penny stock, and he's recommending penny stocks now. This cat needs to learn a little bit about trading. All right. So yeah, you gotta, futures is weird when it comes to how data works. And actually most data is weird on how data works. A lot of times you can buy one data feed and you can't transfer it to different places because like usually your equities data, like a group like us, is a redistributor. We can give equities data to you and you get it from us. You can't export it anywhere else. Futures data, you have to get it from a broker to make it affordable. So what I would do, honestly, Jesus, is if you want it in both places, just call Edge Clear and see if they can, if you have a CQG account. I don't know if you do or don't. You buy it from the CME group. Wait, you buy it from TradingView, not from the CME group. Right? Or do you, because I don't know how TradingView integrates with the data feed. That's why I'm saying I don't know your answer. But what we have a connection to is CQG. Well, no. So let me explain what you're saying. You buy those exchanges worth of data, but you don't buy them directly from the exchange. You're actually buying your data from somebody, probably TradingView itself. Either they're bulk buying and redistributing it and you're paying them, or you're working with the FCM. You have a brokerage account and you're paying them. You pay one of two places usually for the data. The redistributor. You're not paying the exchange directly. That's the subscription you have, which means there's the indices that you bought. So normally you're gonna have like exchanges are here, right? They're gonna supply data to some, I'm gonna just put M for middleman. And the middleman is handing out the data to you. They're usually buying the data in bulk and it's very expensive. And then they pass the charge on to you. And this is just for futures, by the way. So whether TradingView buys a bulk feed and they're redistributing, or whether this is going to an FCM and you have a brokerage account and they can sell you the educational feed, which is likely what you bought if you're paying a couple bucks a month. Jesus. So what we use is CQG in the middle. They have an API that connects to the platform. We use a broker called Edge Clear that goes in and converts your takes your CQG account and assigns it to our platform with your broker and with your FCM and with them. And FCM is your futures commission merchant. So that's like complicated, right? Did you guys just fall asleep with that explanation? I know I did. You see how convoluted and complicated that spaghetti bowl was? That's what makes it hard. So the answer is it's likely no. The only way your data that you bought from whoever you bought it for works is if it's with CQG. And as RJ is saying, CQG works with TradingView transfer. So if you're buying your data through CQG and you don't know if you are Jesus, you call Edge Clear and tell them your situation and they'll actually look in CQG and see if you got an account. And if you do, they'll just take your CQG that's currently plugged into TradingView and they'll go in there and they'll attach a cable to Rocket Scooter and say, boom, you're good. Now you can't open both at once. You can only open one or the other. So, because CQG only allows one API connection or one socket connection per account. But that helps. Now, if you want data in both places, you just buy a second account. It's a moot point. It's $1 a month for top of book for exchange, like this, like CME group, and then it's $10 a month API. So you're talking $11 a month after a broker deposit. So if you want it in both places, sometimes you just have to pay for it twice. So, see, it's convoluted, right? It's a chicken wire spaghetti bowl. Ever since you started using Rocket Scooter, you quit your day job and made a copy of Rocket Scooter on TradingView. Now I'm selling the indicators and making loads of money. Oh, that's hilarious. Can I get some royalties from that? I get some money. I'm eating this truffle pasta from this Italian place last night. This shit was 80 bucks. You better cut me on some of those royalties. Very impossible to recreate what we've made. But that's funny. This truffle pasta is dope. My friend was making fun of me because it's this Italian, it's like this hot Italian place. Lombardi, Jesus, dude, Lombardi. This is the new place. So, I'm on this new kick of like trying the hot restaurants as they open up. All my friends are like restaurateurs and investors in restaurant groups and stuff. So I started networking into the restaurant groups. And now all the new places, I never did this before, but all the new places when they open up and they're hot, I always get a table like right up front when they're popular and try them out. It's kind of fun. It's like chasing down new stuff to try to find new things as they happen. This is like a place that's got a really dope speakeasy, like a jazz club in the back. It's an Italian place. It's over in Uptown Park. You know where that, yeah, it's right by you, dude. It's like where they used to have that, it was like the tasting room or something. It was some wine bar. Now it's just an Italian place. It's not bad. I mean, the food is good. It's just opening week, so like the food came out kind of cold. But I remember sitting there and I was kind of drunk by the time I got to dinner. Don't judge me. And I was making cocktails at home. Different story. But like, when I was kind of drunk when I got there, my friend was like, "What do you want?" And I was like, "I want that Instagram pasta." And I said it really loud because it's like the joke is everybody that we know, all of our bougie ass friends are taking pictures of this and posting it on Instagram. It's like where they have the giant thing of cheese that like is scooped out and hollow. It's like a wheel of cheese, right? Let me draw it. Like this, right? It's just like a giant wheel. And like, you know, there's a little bit of like a depression in here. And it's like a little bowl. Like, again, I can't draw. And the guy stands here with the skillet. It wheels the cart out to the table. He's stirring your pasta and the butter, stirring it up. And he takes and drops it in the cheese, then swirls it around this big block of cheese. And then yanks it out, drops in the plate. Then they stand above you, like above the table, kind of like Salt Bay, like slowly shaving those truffles on it. Ooh. And it's creamy and cheesy, and dude, it's like pretty good. Anyways, the reason we went to this restaurant, because we go about once every 2 weeks. It's like my friends and I, we made this pact that like we would have like more meaningful connections in 2024 instead of just like, you know, working all the time. So like, let's force ourselves to hang out every couple of weeks. And then all of our friends on Instagram were posting this pasta. And I kept saying like, yeah, we were like, fine, let's go do it because all our friends are there. And then my friend was like, what do you want to order? And I was sitting there, I was drunk, and I go, I want that Instagram pasta. And then all the waiters that were standing around were fucking cracking up. And they were like, oh, I guess that is the Instagram pasta. Anyways, I don't know if that story is as funny. You guys had to have been there. But I said it so loud, everybody turned around to look at me. That's right. I want that pasta that I can Instagram. So the cheese wheel pasta, that's all it was. Yeah. So that's what it was. They were like, we should change the name in the menu, the Instagram pasta. And that's my breakfast now because I didn't even eat it all. It's super rich. Yeah, they stirred like the hot noodles in that wheel of cheese, and it just like, I mean, I guess it's just for show, but it was kind of nice. Fucking $80 for pasta. Yeah. They shaved the truffles on it. Marcus gives me, I don't panic. That's right. Oh, sure. So the screen I'm sharing has 3 different charts on it. I'm normally trading S&P futures pretty much on a daily basis. So this is what I'm normally trading. I have S&P futures right here in my area. This is where I execute on my trades. This is like a lot of extra tools that we have on the side. Let me just close it all out for simplicity. Okay. As you see right here, just base platform looks like this. There's the trading portion of the platform. Now I open up some of the tools I'm going to use. Okay. Over here, since I trade S&P futures, I like to keep an eyeball on the S&P equity side using SPY. So I'll keep SPY up in front on the left so I can watch what the equities roll is doing. So I have different calculations in each roll. Futures has some indications. These are pivots in futures. These are pivots in the equities, and they're all clues to what the S&Ps can do in general. So keep them side by side while I trade my futures here. Down here, I keep a VIX derivative in front of my face so that I can kind of eyeball the VIX at the same time. Volatility is a big thing as a trader that most people don't dive into and understand. But if you're trading anything, including the index, especially the index, you must have a solid grasp on volatility. That's all I do. So this gives me an eyeball of like any cautions I'll have in volatility. And let me walk you through what I'm seeing, right? So today, market open here, liquidity map shows upward pressure and hedge pressure supporting. So like already my brain is thinking from here going up. The white line is your next resistance, right? Next resistance. And we have 5 different things we look at for resistances. The only one that's in the way is the futures one. There's nothing else in the way but this little band right here. So this guy pointing up, this is a ratio of the market cap of all the stocks in the index in bull zones or not in bull zones. So an example is bull B stands for bull zone. And what a bull zone actually is pretty neat. I want a quick lesson on liquidity maps. This is what we invented here. We have an algorithm that looks through every single options, trade and contract that exists, and looks for particular relationships. And this is one of the main relationships we look for. If you were to go out there and long like 1,000 shares, let's do 10,000 shares of SPY itself. Typically, there's not another trader on the other side of your trade because nobody's got 10,000 shares on the ask when you bought 10,000. So most of the time, the trader is you. Bank is M for market maker. They're going to actually trade against you. Like they're in the middle, right? They're the casino. They shorted 1,000 to you, so you're engaged in a trade with the bank. And they're looking for a seller to match with you so they can neutralize. But until they do that, they got to go out there and buy some kind of hedging for themselves to neutralize. As the goal of the person in the middle is neutral, they want to take zero risk. Why do they even trade then if they want to take zero risk? Well, dealers get what's called maker-taker fees. So anytime they execute a trade with an order on both sides of the book, they get paid pennies on the dollar for every dollar that's transacted. So they get paid to just pass order flow back and forth. As long as they neutralize their trade to have zero risk, they're just raking in free money. Like the number of transactions they do is directly proportional to the amount of money they make. As long as they just neutralize their trades, then they're just gonna make free cash all day long, zero risk trading. So the idea is they're gonna go out there, say they're short the market to you, they're gonna go out there and buy a call, equivalently so. 100 shares equals a call, so this is about 100 calls. So in this particular trade, let's forget about delta hedging right now. All things being equal, this market maker is both simultaneously short and long the market. And to maintain that neutralization, they're going to do something called delta hedging. As the risk goes up and down and those calls going in and out of the money, they're going to buy and sell the stock at a rate of delta. And this is a whole Black-Scholes thing. So this neutralization process that they're forced to buy and sell to keep their trade neutral is what we're exploiting right there. That's it. So you have essentially a triangle: trader, dealer of the stock, dealer of the option. Yeah, the market makers and it says the market makers winning more money is the reason we have zero DTD options. Yeah, them and the exchanges. Everybody. Every trade you make, the exchange gets a fee, your broker gets a fee. everyone gets paid up the ladder. Everybody wants to create more tables at the casino, 100%. So the neat thing about it is like what a bull zone happens to be is like when you're the trader that long the market, you're long the market against a market maker. We look for that relationship, and when that relationship is skewed to the bull side, that's your bull zone. When that relationship is skewed to the bear side, that's the bear zone. So this is where people are short the market. This is people who are long the market in abundance, according to our threshold. The ones trading against the house. The house is neutral in the middle to both sides of the party without the options. Say if you long the market here and someone shorted the market here and you're both trading against the house in the middle, bulls are losing and bears are losing, house is winning double. So this, what they call liquidity pocket, is where the net sum of all traders are losing the bank. The bull side is where bulls are winning, bear side is where bears are winning in abundance. So now we have, okay, where are most of the bulls and bears parked? Where they're kind of like a line in the sand between them. And our algorithm will find that very clearly. So today, SPY opens in a bull zone. And here's a cool little statistic for you. When this ratio is greater than half, and none of these lights are red against the directional flow, so we're positive, there's no red to the downside, then if you open in a bull zone, we have 3 separate back tests that have supported this. 96% of the time, without a catalyst or a hedge pressure break, you close in a bull zone. We just had somebody do a 6-month back test from our member base and said the same thing. So with all things being equal, there's a 96% probability without a catalyst that you end up right here. So Humble Trader just did a 6-month back test that supported our original findings, and he said the same thing. So as long as all these lights are green, chances are this is your low of day. So even if I were shorting, you know, I would take scalps there, and it's unusual to break that. So if this just is one way to show you how we can use a probabilistic approach to finding where the market is, and that has to do with that ratio is actually the sum of the market cap of the stocks in the index itself, also in bull and bear zones. If it's 99, it means 99% of the market cap of the S&P is in a bull zone as well. Apple, Tesla, Facebook, whatever. So why would the S&P crash and go to a bear zone if the stocks themselves are in a bull zone? That dynamic ratio is showing you that 99% of the market is being hedged positive in a bull zone. So therefore, the S&P is likely to stay in its own bull zone as well. It wouldn't stretch the opposite direction under normal conditions. In normal conditions, well, so those lights being green are your normal conditions. So that's the B part of things. Just means bull zone support as long as the stocks are staying bullish as well. See how pretty simple it is when you kind of boil it down, right? Long has to do with hedging. That's a whole nother thing. I'm not going to explain all of those parts, but essentially when you look at this is hedging against those sold options and other parts of that, they all create pressures when you sum it all up. And it's all forced hand trading, like buyers and sellers that are forced due to hedging. So when you sum up all that pressure, just like, you know, flowing water, things tend to flow to the least pressure area, right? And that's what this is monitoring, that underlying wind or hum that's always there despite what random stuff is happening in the market. There's just a natural push in that direction from that blue, as you see. So it's a great way to start by saying the machine that's running the market, all these automated algorithms are creating long pressure from that blue line. And then that's where we start with our type of analysis. All of our tools are in a similar boat. They're exploiting some kind of mechanics. See, delta hedging is something that everyone does exactly the same. So as an engineer, my thought is, okay, well, if everyone does something the same way, that's a correlation. So we can trust that everyone doing it the same way makes it repeatable, and therefore let's create a tool around it. And we do all of our stuff that same way. It's not like all of our tools have this kind of wow factor of, oh, that's cool, that's a cool exploit. Nothing that we have is like price action momentum, MACDs and harmonics and other garbage stuff like that, complete 70-year-old technical analysis stuff that traders have come to be told to trust despite the miserable failure and performance that you get with it. It's every textbook, it's every YouTube channel, it's every guru on the planet rehashing the same stuff from the 60s and 70s. And so price action can't predict the stock market. You need something more modern. So what we found is we can predict volume very accurately. And that's what our magic is. All of our tools are predicting where volume will be. And then if you know volume's just at a couple of hot spots, like here's volume going to be here, here, and here with 100% guarantee. You touch any one of these lines, you're going to see the volume have an excursion. So we're identifying forced hand trading and selling with very high accuracy. And so then we build our whole platform around that premise. You can't predict the direction of the market. You can try to line things up as much as you can, but the market's going to be random. But what you can do is know where you're going to act at. That's a key level. If I want to short, well, I'm not going to short here. I'm going to take the better short from there if I want to short. If I want a long, well, there's maybe resistance here, so let me exit there. Or, hey, market's moving right here. Oh shit, I don't want to miss out on that. Let me take a long. Well, everyone here would say, ooh, no, you're too close to that pivot. Maybe you're too late to the long. So you can see how with information of like where volume can be, you have all these checks and balances to your own trading. You know when it's too late to get in. You know when you're where you'll be wrong. Like imagine this. How many times you've like, okay, market goes up, comes down, you like a little newbie, jump in and short it right there. And all of a sudden it's squeezing you and squeezing you and squeezing you. You're like, oh my God, I'm going to die. I can't, my trade is losing. Okay, fine, I'm going to close out. Let me close my short. I can't take another loss. And all of a sudden it hits that and then it rejects because that sometimes can reject there. And you go, oh crap, I was right. Let me get back in on the short. Oh shit. I'm down, dying again, right? If you were here, why not wait for there to bet on the gamble that you could be saved? So knowing where volume will be makes you a better judge of the market. And that's what we set our whole premise on. Does that make sense? About to call it a little bit, but so I Citadel's Ken Griffin is building the richest house in the world. Does it know with all to do with the money he's making? That guy's so smart. Waiting for news today? Kind of. I mean, you do have Atlanta Fed GDP now. I don't know if that's going to really create a big effect, but we'll see. GDP, one of being the biggest indications of where we are. So the Fed soft landing, right, is looking for a couple of things. We talked about this before. The Federal Reserve is raising interest rates to battle inflation. Now, what we know, and any economist will tell you, is that this type of inflation that was created after COVID has nothing to do with the hyper performance of a booming economy or an overly ambitious credit boom where everybody's got a credit card and everybody's getting money to borrow the loan. It's not that. The inflation that we had in 2020 comes from the fact that you shut all the businesses down. Everybody goes home because of COVID and doesn't work. Then companies open back up and there's a lot of jobs with not a lot of workers. People at the time are like, I don't want to work, or I'm scared, or I just want to work from home or whatever. And companies are like, we need people now. They open the doors, come back. And so the braver people that jumped in first had negotiating power, supply and demand of jobs. Too many jobs, not a lot of workers. Worker can walk up and say, oh, okay, well, I normally make 100K for this job, but I want 250K because I'm risking my life during this pandemic and you need a person to work and I'm your only option. If you don't give it to me, I'll walk down the street. So workers are now shopping for the salary they want, and that boosted everyone's salaries. Whenever the government decided to shut that down, my first comment on my stream that very next day, and I go, well, I welcome a period of hyperinflation. This will be fun. And nobody really understood what I said when I said that. But I can see it like 20 steps ahead. You can't shut down every business, and when people go back sporadically because of a pandemic, you're going to create an inflated salary situation. And so what that does is it makes the price of goods and services go up, and companies are in the hole, and now they're paying out more money to maintain their margins. They have to raise their prices, and boom, there you go. It's like a reverse kind of inflation. They call it cost push inflation, when the front end costs of production, which is like wages, raw materials. Oh, and the second thing was raw materials, because like the truck drivers aren't delivering the stuff. You don't have the materials to build the things you need to build. So therefore materials prices go up because of the shortages as well. So you have a couple of stacks of causes to that inflation. It's not like inflation is there because everyone's got a credit card and they're all lining up out the door to buy stuff and companies just raising their prices out of greed. That kind of inflation is easily curved by changes in the federal funds rate, which will like destimulate the lending, right? You won't be able to easily get a credit card or get loans if the Fed funds rate goes up. But here's the thing, it's not credit that was creating that inflation to begin with. It was the jobs market, right? So the Fed has only been doing a couple of things. They've been raising interest rates post-COVID and that giant short squeeze we had to essentially like slap Wall Street in the face and slap investors in the face to essentially slow down the growth of the equities market, because companies are still hiring people those ridiculous salaries. So the Fed actually needed to secretly induce some layoffs so that salaries can reset and stabilize and bring inflation down. The problem with cost push inflation, there's not a lot of handles for it. You have to be subtle and sly and kind of like super clever about your approach. And we always talked about that. You know, people come to this stream because they want to hear the chess view of things. Like, what are the real moves that happened, right? And so hold on, let me ban this person. Hold on. Here. You're in timeout, guy. I'm going to put you in timeout for approximately 7. Okay, let me be nice since you're just trolling people. I'm going to put you in timeout for about, it's only a temporary ban, I promise. It's not going to last that long. I'm going to give you like 6,000 or 7,000 years and then I'll unban you. And you're good. Okay. I think that's fair. 7,000 years. Let me set it. Let me set it on my calendar. And done. Okay. Anyways, back to what I was saying. That's nice, right? I should go over 9,000. Oh, that's too mean though. I'm gonna give him a chance. So like in this mode of having hyperinflation, or not hyperinflation, like inflation due to, you know, this thing. Right, let me pull this up really quick. So let me show you guys some cool, y'all want to see some data? You want to see that data? Hold up. Let me show you guys something. I am in such a good mood. I'm in that holiday spirit today. Let's look at this on continual jaw. I'm about to pull some data. Look, this is what I hated about watching or listening to traders. When they talk about economic data, I would always fall asleep because it was so boring. However, let's make it fun with shitty drawings and stick figures and other cool things. Let's look at a couple more things. GDP. And you guys are all so smart. That's why I love you. Remember at the tail end of the stream, by the way, you got about 10 more minutes to call it. So let me go here. This is, and one more thing. CPI. Okay. All right, let's get my data up. Are you guys ready for this? Serious question. You always want to see data from me. Let's pull out that data. Okay. All right. So now you have like all these jobs that are available. Oh, I gotta open up the JOLTS. And all of these people. Hold on. Continuing. Initial. GDP. And CPI. And JOLTS. Hold on. Last part. Somebody doesn't like to be in timeout. See, I like to put people in timeout. Like, you have to sit in the corner Your nose to the wall. Think about what you did. But tell your little brother you're sorry for stealing his toy. Okay. So let's talk about what happened in COVID. Let's go all the way back to post-COVID era, right? When everybody got laid off. And these are jobless claims, right? So jobless claim means you got fired for non-performance reasons. You got laid off and you qualify for what's called unemployment insurance. Company let you go because of not because you sucked at your job or you showed up late or you were, you and somebody else got caught doing a little hanky-panky behind the water cooler. Okay, that stuff doesn't qualify you for government money. Okay, but like getting laid off for things that aren't your fault and your company has unemployment insurance, you can go file a jobless claim with, whatever unemployment insurance, you get unemployment check. And this is a measure of those people, right? You got laid off because COVID, the government shut your business down, you got laid off, and that's everybody. And so this is a week over week filing of people that are, let me kind of zoom in here. So like week over week, right? Everyone got laid off and then slowly they started coming back. So these are new files. Like the day you get fired, if you get fired in this week where my candle is, you go to your car, you call your mom crying, and then you're like, I lost my job. And she said, well, file for unemployment. You'll get some money, and you go do it. You're like, okay. Well, now you're in this candle right here. You're in that data point. You just got your job cut from you, and you go out and file unemployment. So this is the number of people that filed unemployment that week for the first time. And you can continuously reapply every week. There's a whole process. And then if you continue to not have a job, every week you can get another you can apply for another check. Now, as you see, fewer and fewer people were losing their jobs, as was expected. As the world got slightly better, people were actually going back to work. And this continuing jobless claim is people that are filing for like week 2 or later. So essentially you had, the number of total people filing after the first week is here. So you can see the two charts are like, one of them is layoffs. Like these are the people getting laid off. And these are the people who are like, oh man, I still can't get a job. I've been laid off for a while. And so let's kind of see like where we are currently in the current data set. Let's go all the way here. So at some point, right, the continuing jobless claims stopped going down and stopped going down and stopped going down in October 22. And then we had the stock market started selling off and companies started laying people off. Because during this time, wages were like going through the roof during that hiring spree. And this is what 2022 looked like. This is the CPI and this is your inflation. Because everybody goes back to work with all these jobs available. And the one guy that's like, I don't need to wear a mask. I'm brave. Give me a job. The companies are like, okay, so we need this guy. Okay, he makes 100K. Let's give him 200, whatever. We need somebody now. Fuck our competitors. Bring this boy in, give him a job. Let's just pay him whatever. We'll deal with it later. Well, let's pay him whatever and deal with it later. Plus those high costs of goods. What this guy drives a truck, right? Here's this truck. And his truck goes and picks up lumber from the lumber mill and brings it back. And these guys need lumber. Well, they don't have a driver. So them trying to get the lumber, that price is also getting jacked up as well. High prices, high wages creates inflation. And there you go. The cost push inflation is created by the front end of the logistical chain, like being blasted up to the top, like super expensive, right? So now the goal of the Fed is to bring inflation down. And normally if you raise the funds rate, like banks don't lend out money as easily to like you and me. So we're not out there buying shit we can't afford, credit cards that we can't pay off. But instead, what the Fed did was like during this mode, remember COVID crashed the stock market, right? The stock market rallied and then like shot up to highs. And so in this stupid mode, companies had all this extra income on their stock prices. They're doing stock buybacks, making all this money. And all of a sudden, companies have all this money to continue to propagate their stupidity of hiring people at ridiculous salaries. And all of you here, shame on all of you. And I guess shame on me too. Well, actually, I don't have a salary, but shame on all of us because we're all to blame for working at home. Remember the office you used to have to go to for $100,000 a year? You go there 9 to 5 every day, and then you got laid off. And now you show up to work one time a week in your underwear into a fucking Zoom call in your living room on a laptop, and you watch Netflix for the rest of the week, and you get paid double your salary for that. Shame on all of us for creating inflation. That's our fault. We all did it. Let's be honest. So the Fed is like, all right, we gotta slap this stupidity in the face. We gotta get people. There's a lot of jobs available, not a lot of people. Well, let's lay some people off. let's make some more. Like these guys are, oh my God, I'm getting laid off. These are people, I promise. And then what the Fed did was when they raised rates, it actually started scaring the stock market, and we had like a year worth of selling. In that mode, consequently, inflation came down. Look at that. That's backwards of what you'd think, right? But what's kind of neat about that is when you look at the same data, let's go back to the jobless claims. You can see kind of the same thing was like happened at the same time. It's kind of neat. These are your initial jobless claims. And as you see, in January of 2022, there were like waves of initial layoffs. Like now companies are starting to lay people off as the stock market's coming back. And that was really what the Fed was trying to do. And as those 4 waves of initial layoffs were happening, look at the total number of continuing jobless and people still laid off. That buffer of employees is growing. The laid off unemployed job market or job pool is getting bigger as those layoffs are now saturating the market with workers. And you had a couple of available jobs, and now you have all these people that are like, hey, I can't get my job back. And the company's like, well, because you want $200K a year, just send your underwear and come to a Zoom call. You need a regular salary. And this guy's like, but I can't. It's about a house during COVID. It was $300,000 and I paid $600 for it. And I can't afford the mortgage. I need that high salary. And the companies are like, tough titties, bro. Like, yeah, in your own situation. So it's a game of chicken between the companies that don't want to pay a lot and the people that want to get paid a lot because they're stuck in shit they can't afford. And the natural result of that is who wins in this game of chicken. Well, ultimately, you'll be desperate enough to take whatever you can get. Your 100K job that you're now getting paid 200K for, you're like, your wife is like, honey, you need to get back to work. Yeah, but they're not wanting to pay me the salary. You can't afford the house. So you're arguing at home about getting that job at that salary. And then as you go behind on your bills, your wife or your husband will be like, look, you need to go get something. We can't afford our bills. And so you can go to the job and say, okay, look, I know I want 200. Can you give me 150? They're like, nope. You can give me 125? Nope. You give me 100? That's what I used to make? Nope. Okay, fuck. Just give me 90. Give me something. I'll take any kind of job. And that mentality, right, is what's happening right now. And that oversupply of unemployed people with the lack of available jobs, which is this report, the jolts, fewer and fewer and fewer job openings month over month. So now the supply and demand balance, you guys see, has shifted to the other way. Dylan said, I'm describing you, bro. Can you chill? Dylan, like, it's like, wow, Matt, did you have to go there? I'm sorry for throwing you in the bus, bro. You know I love you. Okay. That was all of us. Well, I mean, I didn't get laid off because I'm the CEO. I didn't lay myself off, but had I still been an engineer like I was a million years ago, I would have definitely been laid off. Okay. So fewer available jobs and more available workers now is creating a shift. Y'all see that? Supply and demand is the other way around. So therefore, that competition that I was just describing is causing wages to come down. You can see that in some of the other reports. When wages are coming down, you would expect inflation to come down because it's the cause. And this is what you're staring at right here. And inflation has been coming down to that effect. So the Fed is actually controlling inflation, not by directly from the funds rate, but by raising the rate to scare the stock market, to have people get laid off so that people go out and there and get less salaries. And they desperately want that job and they're going to work really hard to get it, which means they'll drive a little faster and get that lumber there quicker. And the cost of materials come down too. So like essentially, that's what they call the soft landing. And you keep hearing people in Wall Street talk about that. And the soft landing is that it's like the Fed wants to raise rates just enough to scare the market into selling off. Believe it or not, it's really what they did. But they say it behind closed doors. You just have to be like a chess player to see what they're doing. His narrative states job market and all these other, he's talking about it without telling you what he's doing. It would sound like give you like willies if you were like, Jay Powell is like, let's get like 15% of the job force laid off. Oh, Jay Powell, that's brilliant. It sounds kind of morbid, right? And you're going to storm in the Fed offices with pickets, right? That's really what they did. They wanted to fire you guys for a little bit, so slap you in the face and you reset the salaries and then everything's good. So the point I'm making is that 100K, whatever, 100K. But the idea is that people took ridiculous salaries because of the supply and demand. Now supply and demand is the other way around and the labor market's starting to kind of normalize and neutralize with what it should be, right? Wages coming down, inflation's coming down. And it's because inflation's coming down, the federal funds rate is not being raised as quickly. As a matter of fact, the last couple of meetings, right, the Fed is not raising rates anymore. Yay, guys. Mission accomplished. We did it. Kind of, right? We're still halfway there. But here's kind of the boat, right? Market dips in COVID, now rallies like highs and highs and highs and highs, and we're in a very problematic point of inflation. Fed starts announcing rate hikes here, quantitative tightening here. Wall Street sells off for a year, inflation comes down. Look at that. They knew that same correlation we did. Let's fire some people, inflation comes down, good. So now the market's here again. We're like almost at highs and inflation's down, congratulations. Now the market has a little more resiliency to absorb some impact from the Fed, right? And what you're staring at right here is the confusing part of what happens next. It's hard to guess the next step. All through here, rate hikes were going up, quarter a point, half a point, 3/4, like it was getting really heavy. And then right here, we're raising like zeros. We're not raising rates anymore. So the Fed raises too fast, the market can, topple pretty quickly. So when markets are rallying, the Fed's going to raise rates. When markets are selling off, they're going to cut rates. They're literally driving the stock market like Goldilocks zone. And again, that's your soft landing. If they raise rates too fast, the market falls too fast and people get laid off. Now that might help inflation, but then you get the adverse effect of nuking GDP. So if you lay off too many people, then GDP goes down. And those are the two things that you're fighting for a healthy economy. You need people to become more and more employed. You need your GDP quarter over quarter to grow. And therefore, the labor is converted to shit that people make. And that's really what that soft landing is looking for. Let's fire enough people so that salaries reset, but not too many people that we create a stagflation recession and GDP starts to plunge, because that creates a bigger problem. So they're trying to essentially let the stock market fall enough to reset salaries. And then when it rallies too far, they're going to slow it down by scaring it with rate hikes. And so the Fed is being very careful about driving the stock market, which you never think they really intend to do so. But they know the stock market's going to be that direct handle to change salaries and wages, right? And so they're really like, so as the market's rallying, you can imagine Fed's going to probably start raising rates again, because they need to get this down way below 2% and 1% to hit their yearly targets. Anywho, that's the end of the speech. So that's where we are right now in this kind of weird boat of Fed is now not raising rates quicker, but we are pushing to all-time highs. So one may argue that we might like raise rates again early into the year because the stock market can handle it. All the data is looking good though, right? Things are looking okay. Inflation's still a problem though, because even though the CPI is coming down, the big expensive things you want to buy are still like ridiculous prices, like houses, cars, steaks. I don't know. What do you guys buy? Sushi, cocktails. I can't go to dinner without a cocktail costing $25. And now with that said, that circles all the way back to the start of my story as to why I was drunk before I went to dinner last night. And I blurted out, I want to order the Instagram pasta. Is off the top of my lungs, cracking up every person, my friend, the waiters, because I was plastered before I went to dinner. These fucking cocktails are $25 a piece. So at the end of the day, Papa Bear, no matter how rich I am, still want to save money. That's how we go. We'll get out of here. Made $300 today trading. Not a lot, but it's $300 I didn't have. Hey, I'll go buy a couple cocktails with that. How about that? We're to check out Rocket Scooter. Got a big cool thing happening. This marketplace is launching very soon, so we're excited to bring that to you guys. Love y'all to death. Thanks for hanging in here with me. We get out of here. Zoom call at 3 o'clock. We'll see y'all later. Start next week. The camera's gonna come back on, so I'm still trying to figure out how to do that. Oh shit! I gotta wake up and comb my hair and wear pants now. Well, it's a new era. All right, check us out on the Discord. We'll see you on a little bit. Link in the bio. Go down below or description. Check it out. Camera. Looking to see my pretty face. Or schedule a Botox appointment before I turn that thing on. All right, we'll see y'all later.